The SEC recently approved in-kind creation and redemption for Bitcoin ETFs. Most coverage either ignored it or called it the most bullish thing ever. But neither approach helps you understand what this actually means for Bitcoin, the broader market, or your portfolio. So let me break down what changed, why it matters, what the real risks are, and how to think about this development rationally. The things that changed were essentially the mechanics. An in-kind creation and redemption means that previously, when institutional players called authorized participants wanted to create or destroy ETF shares, they had to use cash as an intermediary. To create shares, they had to sell Bitcoin, get cash, then give cash to ETF provider, then receive ETF shares. ETF sells Bitcoin, you get cash, and then you can skip the cash step entirely. To create shares, give Bitcoin directly, receive ETF shares, and to redeem shares, you give to ETF shares, receive Bitcoin directly. This eliminates multiple transaction costs, reduces tax implications, and removes what's essentially called the tracking error when an ETF's price drifts from the underlying asset due to structural inefficiencies. The historical context for this is that this current legislation is unprecedented. Gold ETFs have worked like this since 2004, and when they launched, gold was around $400 an ounce. Today, it's over $2,000. Did the ETF infrastructure cost that? No, but it certainly made institutional gold ownership much easier. Here's what we know from gold's experience in this, though. Is that ETF's assets grew from 0 to over 100 million ounces in 2 decades when institutional ownership became normalized. Price volatility decreased, and over time, liquidity improved. But gold also went through major drawdowns, including a 45% drop from 2011 to 2015. The key insight is that better infrastructure doesn't guarantee price appreciation, but it does tend to increase institutional participation over time. The institutional reality check is that large institutions move slowly and have strict risk management requirements. A regulatory change doesn't immediately open the floodgates. What this change actually enables, though, is that pension funds can now include Bitcoin ETFs without the structural inefficiencies they typically avoid. Corporate treasuries have a cleaner mechanism for Bitcoin exposure, and family offices get better cost efficiency on large allocations. But institutional adoption faces real barriers this doesn't solve. Bitcoin's volatility is still about 3 to 4x of stocks, and regulatory uncertainty in other areas still prevail. Internal investment committee approval processes and fiduciary duty concerns. The most underappreciated impact might be on price discovery, though. When ETFs can't officially arbitrage with the underlying asset, you get price dislocations. We've seen this with Bitcoin ETFs trading at premiums or discounts to net asset value. And in-kind redemptions should reduce these gaps, leading to tighter bid-ask spreads and more accurate pricing, reduced arbitrage opportunities, which is actually good for overall efficiency. This matters even if you never touch ETFs because it affects the price of Bitcoin itself. Here's what could go wrong, though. Is that concentration risk. If a few large ETFs dominate Bitcoin holdings, they could become systemically important. What happens if one faces redemption pressure during a market crash? The regulatory reversal and rules can change. The SEC could modify or reverse this decision if they see unintended consequences, and with market structure risk, more efficient ETFs might actually increase volatility during stress periods as institutional flows become more direct and immediate. There are also custody concerns, which in-kind redemptions require ETF providers to handle more complex Bitcoin custody operations. Any security incident becomes far more consequential this way. And the larger scale thing of how to think of this is that do not view this legislation as a higher guarantee or a guarantee of higher prices. View it as improved market infrastructure that could reduce friction for institutional Bitcoin exposure and improve price efficiency through better arbitrage mechanisms. It also works to normalize Bitcoin as an investable asset class over time for Bitcoin holders. For Bitcoin holders, this also incrementally positive, but won't drive short-term price movements. I would recommend focusing on a long-term Bitcoin investing thesis. For ETF users, however, you should see better tracking and potentially lower costs over time. But remember, you're still exposed to Bitcoin's fundamental volatility. And for the skeptics out there, which I know there are many, this does not change Bitcoin's core value proposition or its risks. It just makes access far more efficient. And in all, the SEC's approval of in-kind redemption is meaningful for infrastructure development. It removes friction and can facilitate institutional adoption over time. But the infrastructure changes still work slowly. The gold ETF took years to show major impact in the market, and Bitcoin's path will most likely be similar, gradual institutional adoption rather than sudden buying waves. But the real value here isn't predicting short term price movements. It's in understanding how financial infrastructure evolves and what that means for long term adoption of any asset, including Bitcoin. The key thing here is to always stay curious, stay skeptical, and remember that the most important developments often happen quietly in the background. Thank you.